Hello, it's Mario from the Montecinos Group. Specialize in investment property financing for residential and commercial properties. And we're going to dig into some recently funded loans here in this little presentation. So let's get right to it. So basically, the kind of the thread here is we're building a legacy through real estate investment, right? So specifically with value add real estate and then buy and hold properties that have the proper cash flow. And just like from a high, what are your options when it comes to investing? People have different options, right? They can have a really passive investment. They could just keep money in the bank, which is basically your cash and savings. It's the bottom part, that blue section of the graph there. Next one, a common one is stock and investments. There has been significant wealth created in stocks and investments. The purple one on top is business ownership. So owning businesses for a long period of time and then selling them. And then the biggest piece on this graph, the orange, is real estate, right? So over the last decade, real estate has contributed significantly to wealth accumulation, showing increases of 65% in net worth, demonstrating the stability and potential of real estate investments. Doesn't mean all real estate is stable, and there's different seasons in real estate cycles, right? But overall, long-term wealth in real estate has always been a huge piece of the pie when it comes to wealth accumulation. So I thought that was a fun little chart to take a look at. Um, Next one. So when I started, so I've been in business over 20 plus years, and I worked a lot with first time home buyers back in the day. And this was always a very interesting stat to me, basically homeowners net worth versus renters net worth. And the gap has kind of continued to increase. With that, in this chart, you can see that homeowners have, on average, the median net worth is 396,000 versus the typical net worth of a renter is 10,400. So that's 30 times more the net worth there, and a lot of that is just forced savings, right? A big piece of that is every time you pay your mortgage, you're paying down your principal, assuming you have a principal and interest mortgage on a 30-year fix, which is going to be your common mortgage, and and then also the long-term appreciation of that asset. So those are a couple of big drivers when it comes to net worth for homeowners versus renters. So net worth is basically all of your assets like stocks, bonds, money in the bank, real estate minus your debt. So that would equal out your net worth. So when you combine that too, so that's what they're looking at there. And once again, that's 396 versus a typical net worth of a renter is 10,400. So very powerful chart there. You can see the distance and the motivation to be on the homeowner side. All right, so digging into the meat of the presentation, I wanted to talk about some recently funded loans. These are value add real estate purchases, meaning they're buying a property to fix them up. And then one of the strategies is to sell the property. Other strategies are to hold. But you'll take a look here. So the first one on the left this is an experienced investor recently got connected with, and they're putting 10% down on this investment property and then also getting access to 100% of their rehab budget. This is a small cosmetic rehab. They bought it significantly under market, so they only need roughly 50K to kind of clean up the property and then put it back on the market right away. Their purchase price was 550,000, and their loan amount was 545,000. So that's 90% loan to cost. That is pretty much the max leverage that is available, especially with institutional money out there. So this individual had a track record, and then also he bought this property right. And we'll go a little bit deeper dive on that scenario then in the next slide. So we'll go into that further. So this is fixed and flip financing. So this is money for 12 months. So at the end of that 12 months, they're either selling beforehand without a prepayment penalty, so they can sell it whenever, and or refinance is the other option there. The next one in the middle, this is a bridge loan. This is in San Diego, California, Coronado, and they needed a private money loan to close on this property. Initially, it was set up as a fix and flip loan. The borrower decided they did not want to have the rehab budget. They had 1031 exchange money. They sold the property, and they were taking those proceeds, tax deferred, and rolling it into this new property. So that was their kind of choice there. So it was about 25% down on the purchase there. And this is a fallout loan. It was another private money lender had the loan, and then they were unable to fund the loan. So I was able to come in with a partner on there and structure this deal. We'll also go over the characteristics of the deal, kind of what made that more unique. But typically on a bridge loan, the max leverage you'll get is 25% down for most capital partners, and no income documentation needed, no debt to income ratio. They just needed to close on the property quickly. Next one on the right here is a fix and flip property. This is in Newport Beach, California. I think what's interesting about this scenario here is, so the borrower has industry experience, but in their name personally, they have not bought and sold a property in the last 3 years. So when it comes to lending, they look at track record, right? And there's different leverage. So we were able to kind of built in the track record. The individual was not new to housing and building, so we were able to go in deep and explain that connection as far as the borrower's expertise. And we're able to do a 15% down loan on a property in Newport Beach, and quite a large budget, and able to get access to 100% of the $550,000 to repair the property. So this is not there wasn't any square footage being added, just high end finishes for the area. Newport Beach, California has high end real estate, so it would require a much larger rehab budget to fix the property. So that was a good one with the borrower's experience to get that amount of leverage. And that loan amount was $2,426,750. So $2,426,750, and that was 85% loan to cost. So they put down 15% off the purchase price in the rehab budget. And then what the property appraised for ended up being about 70% of that. So real quick, if the loan amount was $2,426,750 divided by 0.7. So that means the appraisal value came in right around 3.5, so 3,466. I think it was right around 3.5 on the after repair value on there. And then this loan amount for this bridge loan was $3,918,750. So that was right at approximately 75% off of the 5.3 loan amount. So next we'll go into the first scenario where they put 10% down. We're going to go and look at a little bit more of the details on this one. So this is, as you can see on the right, this picture, another beautiful property in Alhambra, California. So this is a suburb of LA in East San Gabriel Valley. And it was a purchase price of $550,000. This was an experienced investor. They had 10% down, so $55,000 was the down payment. The rehab budget was $50,000. So that was 90% loan to cost. And I always like to stop here because we look at the total loan amount on this thing. It was $545,000, right? That is phenomenal leverage because they bought this place for $550,000 and they're going to have a loan amount for $545,000. So why they're able to get that amount of loan amount is because of the after repair value. So the after repair value came in at $840,000. So that provides protection because of the equity created, the potential equity created into this property. What I think is unique on this property, buying a property in Southern California, and they pretty much bought this property at 65 cents on a dollar. So if the property came in at $840, I look at $550 purchase price and divided by the after repair value, $840,000. So they're buying it for 65 cents on a dollar. So people always talk about that 65, 70% on a dollar. Like everything's kind of specific, like market specific. This one's even more of a win because it's such a light cosmetic rehab, right? It's different if you're buying at 65 cents on a dollar and you have, a huge rehab budget that you have to kind of like factor in there. But this one is clearly an experienced investor that bought the property right, had access to the deal, and should do really well on that. The initial payment on this interest only payment is $4,434 to carry, and then as they draw down on the rehab budget of $50,000, then the payment will gradually step up. But that was the case study scenario on that property, investment property, fix and flip. Alrighty. So next one was the bridge loan case study. So this is a property in San Diego, California. This case study illustrates so a luxury property. So it was a $5.3 million purchase price, right? So this is high end. And there was a loan amount of $3,918,750 and LTV just under 75%. So initial first glance, this isn't like that crazy of a scenario as far as like, oh, well, that's not like amazing, very, very aggressive leverage. But the borrower chose to put this down, like I mentioned before, because they had funds from a 1031 exchange. So they were rolling that in. They also had additional liquidity there, but kind of the inner workings of why this loan was turned down elsewhere is because borrower track record, right? It is very important, especially when you get a larger loan sizes. They look at the track record more. There was a lot of complexity because the track record came with different entities that own properties that were bought and sold, and within those entities, there are various ownership levels. So, as doing this 21 plus years, we get exposed to lots of different scenarios, lots of different LLC structures. So, able to put a fresh set of eyes on it and understand and really connect the dots to make the investor feel comfortable with the situation is kind of where the experience with an experienced investment property lender, I think, paid off in this scenario. And we're successfully able to close on this for the partner and the borrower there. So that was a good scenario from that like expertise structuring perspective for this property bridge loan in Coronado, California. All right. So the characteristics of the borrower. So the other thing was there was an exception. The credit score came in at 678. Really, the investor guidelines and comfort level was at 680. So at that time, that was additional kind of hurdle that came into play. So that was something that needed to be overcome. The borrower was a non-U.S. citizen, so there was that degree of complexity on it as well. They did have good compensating factor. The cash in hand, they had about 1.8 plus when it came to assets. So with funds in a 1031 exchange account, and then also business funds. The borrower is definitely self-employed. They were a homeowner and they were not a first-time investor. So that helped out the situation in there. So questions, if you guys ever have any questions or inquiries, we're looking at loan scenarios all day long. We'd love to help out. You can reach out to us and see how we can partner up on a deal and share our expertise. And feel free, you can book a call here. You can also call me. My cell phone is 562-787-8902. Once again, that's 562, next 3787, last 48902. You can find us on YouTube. You can email us, and you can also book a calendar invite here as well. So we just want to say thank you for taking the call and joining us. Look forward to helping out, and hope this was good. Take care.